So now we'll turn our attention to weighted average cost of capital. This is problem set 7, the very first problem. The way I've set this problem up is it covers cost of capital, everything anyone needs to know about it, except for those people actually calculating it in the firm. In the firm itself, much more detail, many more calculations, but they're not doing anything different than what we're going to do in this problem. Other textbook cases will bring in things like preferred stock, bring in issuance costs, those type of things. Those are really not that important to understanding the concept of cost of capital. So what I encourage you to do, work through these examples, get used to the calculations. They're not that difficult. And then go back to your own firm and ask them how they calculate cost of capital. I know at UTSA it's a much more detailed analysis because when they do the cost of debt, they include not just the debt that UTSA borrows, but also the deposit accounts at their banks, the certificates of deposit, the savings accounts. It includes the reserved products in the life insurance company, the annuities, the whole life. It even includes the auto and homeowners policies. So it's a complex calculation, but the complexity is only in the details. It's not in the concept. So this is a good problem to step back and say cost of capital. Remember that cost of capital, this is the discount rate we're going to use to do cost-benefit analysis to figure out which projects the firm is going to accept and which it's going to reject. So it's an extremely important number. If we have too high of a number, we'll be turning down value-adding projects. If it's too low of a number, we'll be accepting value-destroying projects. So it's an important number. The key here in setting this up in Excel, let's first figure out what numbers we need. So the first number we need is cost of debt. So with cost of debt, we'll call that KD. We'll have two components there. We need a risk-free rate. We did this before when we did the bond valuation, and we need the spread. So this is not new. We've already done that before. And then we need cost of equity. We'll call that KE. And we've already done that as well. We need a risk-free rate. We need a market or equity risk premium. Remember, those two terms are the same. And we need a beta. And in the financial application set A, we'll get in more detail how to do the beta. But that will give us the cost of equity. We need to know the weight of debt. So with the weight of debt, we're going to call that WD, and we need the weight of equity, and obviously we'll call that WE. We also need to know the tax rate. When we put all this together, this will give us the WACC for the firm, the weighted average cost of capital. And here's the formula. It's not that complicated a formula. We want the weight of equity, the weight of debt times the cost of debt. There's one more thing there. I'm going to put the rest of it in. I add this one thing in there. Plus the weight of equity times the cost of equity. So pretty straightforward. What percentage do you use debt? Multiply that by the debt rate. How much of your capital comes from equity? That percentage multiplied cost of equity. You only have to make one other adjustment, and that is the fact that debt interest expense is tax deductible. So we get to reduce our cost of debt by 1 minus the tax rate. So there's the formula. So all we have to do is find each one of these pieces of the formula. And the risk-free rate, remember we did this in the problem set when we valued the bonds. And so when we're looking at this one, what we'll say is we need a risk-free rate and a spread. So let's look at what they tell us here. Kroger's bonds have an average maturity of 7 years. So we're on the 7 years. Our risk-free rate is going to be 7 years, and our spread 7 years. So what is our risk-free rate? If the bond's average maturity is 7, we'll use a 7-year treasury. And in reality, a firm will use its actual cost of debt for every piece of debt that it has. And it's not the debt, it's not the coupon rate, it's the actual current yield on that bond. Remember when we valued bonds, we had a coupon rate. This is the application set 3. but we use the current. This is a 5-year bond, so we use the 5-year treasury. We're doing the exact same thing here. We have a 7-year bond, so we're going to use 3.6% for the 7-year treasury. Obviously, this problem was set up some time ago when treasury yields were much, much, much higher than they are today. Today, everything's below 1%. And then the spread, well, it's a AA rated bond. So AA rated, 7 years, you have 80 there. So the spread is 80. So we do, remember, we do plus 80 divided by 10,000. You always take the spread and divide by 10,000. And I'm going to change that to a percent with 2 decimal places. And then the last thing we do is we just add those two numbers together. So there's our cost of debt. We're already there with the first piece. And for the cost of debt, we know we have a tax rate. Their marginal tax rate, this was some time ago when the marginal tax rates were still 35%. This problem's a little bit dated, but that's okay. So their tax rate's 35%. So we're almost there to the end. Now for stocks, remember for stocks, for the risk-free rate, we use the 10-year treasury. That's 4.1%. The market risk premium is given in the problem. I call it equity risk premium, so I'll change the title here, but those two things mean the exact same thing. We have two terms that mean the exact same thing. The equity risk premium is 4%, and then the beta, for the beta, what we're going to do with the beta, I'll put it down here below. You're going to do more of this in problem set 8. But beta, we're going to talk about a few things. The first thing we're going to ask is about the revenue of the firm. Is this cyclical or defensive? Cyclical firms, they're very sensitive to the economy. When the economy is doing badly, their revenues will drop a bunch. When the economy is doing well, their revenues go up a lot. Defensive companies, they tend to do okay whether the economy is doing poorly or well. But this is Kroger's. Kroger's is a grocery store. So we're going to say this is definitely a defensive company. So the beta is definitely going to be below 1. That's the thing. Cyclical firms have betas above 1. Defensive companies have betas below 1. We'll talk a lot about this, more about this in class, or we may already have addressed this in class if you've been through the slide deck for the class. The second thing we'll ask about is operating leverage. Here we're asking, is it fixed costs or variable costs? If the costs are fixed costs, then that will reduce our beta. If the costs are variable, that would increase our beta. So we can see for Kroger's, their cost structure is slanted more toward variable costs and less toward fixed. That makes sense because, you know, if tomato prices go up, they raise their prices for tomatoes. If coffee prices go up, they raise their price for coffee. They have a variable workforce. They have a lot of hourly workers. So theirs is more variable. So beta even lower. The next thing we'll look at is financial leverage. And that's how much debt do they have. If they have a lot of debt, their beta will go higher. If they have little debt, their beta will be lower. And so let's look what we say here. And their debt to equity is slightly higher than that of the average company. It's above average. So it will push beta up some, not much. Now here in this problem, I said that Kroger's debt was slightly higher. That is not true today. Kroger's debt today is significantly higher than the average stock. But at the time I did this problem, it was slightly higher. And the last thing we look at is the history of the firm's beta. And I give this history here. What you'll do in problem set 8 is you'll actually create this chart and you'll go through this 4-step process again. So history suggests the beta median is maybe around 0.7. That's consistent with the above analysis. So I think 0.7 sounds good. So I'll use a 0.7 for my beta. For grocery stores, I tend to use betas, and this will just, you'll just have to get this over time with some comfort with it. Grocery stores, I usually go anywhere in the 0.5 to 0.7 range. I might use a 0.6. You can see their median's probably closer to 0.75. However, this is a rolling 5-year, and you notice their beta used to be much, much higher back in the 90s. If you look here more recently, more recent time, and especially here real recently, it's been much, much lower. However, I do know that Kroger's debt today is much, much higher. So 0.7 is probably on the higher end of what I would use for the grocery store, but it's a reasonable number. And so remember for cap in, it's the risk-free rate plus the equity risk premium times the beta. And again, I want to use percent. Go 2 decimal places. So now we have our cost of equity. What I'm going to do is I'm going to highlight in green the numbers we need to input. Because when you do this for your next problem, what the biggest error I've seen students make on these exercises is they forget to change all of the numbers. So let's put them all in there. The ones you change, you don't need to change this one because that's a calculation and that's a calculation. Now let's do the weighted debt. So we can see Kroger has $8 billion in debt and $5 billion in net worth. So what we'll do is we'll take their debt divided by their debt plus their equity. And I'll put that as a percent, 62%. So I just did 8 divided by 8 plus 5. And so this one will simply be 5 divided by 8 plus 5, right? Plus 5 divided by 8 plus 5, or you can just take 1 minus that number. So either way is fine. Make sure if you do them as separate calculations that you have something that adds up to 100%. So now we have all of our numbers. So the rest of this problem is just a matter of plugging things into the formula. So we do equal the cost of debt times, the weighted debt, the weighted debt times the cost of debt times, open parentheses, 1 minus the tax rate, close parentheses, plus the weight of equity times the cost of equity. And I had a, whoa, not sure what Bill Gates is doing for me there, but not really helping me out a lot. I had an extra multiplication sign in there. So weight of debt, cost of debt, 1 minus the tax rate, weight of equity times cost of equity, 4.41%. You notice that's not too far off from the actual cost of debt, but that's what the advantage of having that high tax rate and saving us on the numbers. Let me do it by shorthand just to make sure. Sorry, I've got a little sticky key there. And I get close to what I had here because of rounding. So yeah, that looks like the right number. So that's what you're looking for. When you do the other problem for the second company, it's Packer, and Packer is definitely a very different company, definitely not a defensive company. So you have to think about what number you use there. But that's what you're after. There's the answer right there, 4.41%. I'll put that formula over on the side. Hopefully you're in the same rows I was in. I started on row 4, and that gives you your cost of capital. And again, Bill Gates is just going wild today. I don't know why he's doing that to me. All right, so that gives you cost of capital. Now go to your firm and say, hey, how do you guys do it? And what you'll find is each one of these numbers, especially right here, cost of debt. If UTSA, this could be 80 sheets in a spreadsheet. Cost of equity is, I think, the sloppiest part. We may talk about this some in class. I think some firms need to spend a lot more time on this number. They tend to throw this number together in a few seconds, and they spend hours and hours and hours getting that number exactly right. But just look at what your firm does and just ask questions. Take this class as an advantage, as an excuse to go talk to your CFO department, and figure out how they're making decisions about your firm when they're going to grade a project that you're doing. And they're going to use a cost of capital of 4.41. How do they get that number? Because it will determine whether your project gets approved or not.